So what I've discovered and thought about is that buying the banks right now is basically a proxy bet on long bonds, because now that the banks have come down, it's reflecting the fall in price of the longer duration bonds. And because many of them are forced or by choice hold a large portion of their assets into treasuries from longer term duration, they're basically a play on bonds. So it's like a leveraged play on bonds in a sense, or at least a different way to play it. It's just with a lag. It takes the banks longer to reflect the price of the bonds. So that's kind of what I was thinking about when I was having lunch here. And yes, I'm on my phone again, but this one's probably a better sound environment than the cafe. Cafe was super loud. I'm just sitting in my car over here. It's raining a little bit, California weather. The other thing I thought about is, or been thinking about, is that PTSD or PTSD, the leveraged regional banks fund. I got a question on that and what I think about it, because I think the failures of the bank are going to be reflected in a permanent impairment. Not only the banks that are still in the index of KRE, but the ones that are moved out, right? They have to be replaced and they effectively gone to zero. So that's kind of a permanent thing, permanent hit. So if you want to play the relief rally in the regional banks and the KRE, then that's fine. If you want to do like like a little 1 week trade, I would not hold it for more than a trade, more than a week. But if you want to play it leveraged way, fine. You can even buy a call option on that fund and collect some major gains. But just know that it's pretty risky. And with all these leverage funds, I wouldn't hold them for a long duration because of the theta burn, the decay that they experience. So that's my opinion on that. If you want to play it for a week, fine. But the thing is, like, I would not expect the fund to go back, KRE, the regional banks, to go back to the previous levels, is what I'm saying. Like, even if bonds recovered right now and reached a price that's closer to what bonds were priced, a few months ago, I still don't think that that'd be the right play. I don't think the regionals will be at the same level for quite some time, because of that effect of permanent loss. And not only is the index hit because of the failures, the deposit base is also going to be getting hit, because now people are actually paying attention of where their money's at, and they're going to be shifting them to time deposits, money markets, CDs. They're going to buy treasuries with them. They're going to put their money in high yield checkings accounts. So it's a bit different than it was a few months ago, where people are just like, oh, okay, yeah, I'm going to leave a big portion of my cash into the checkings account. But now, not only are they looking for safety, they're starting to probably even look for yield. They're like, okay, why is this over here collecting a bunch of risk with no yield? So they might start looking for banks that give actual interest on checkings. And those banks do exist. I think one of the banks, funnily enough, it's kind of an interesting name, but it's called, I think, Redneck Bank, that gives, market rate percentage on the checkings, at least the first 10 or 20,000 or something like that. There are plenty of banks. A lot of the credit unions do it. They'll give a percentage, high yield percentage on the checking accounts. And I'm sure there's some regional banks that do stuff like that as well, or at least their savings accounts spend a lot more. So I'm sure that people are making moves, which is going to be eroding some of the deposit base on the banks that rely on them customers that not dumb, but perhaps, either lazy, unaware, can't be bothered, or what have you. Customers where they're basically lending their money to the bank at 0 interest rate, and then the bank turns around and apparently is buying, many of the banks apparently are buying 30-year or long duration assets like treasuries for almost no interest. So that's my main point for today. I just want to make a quick video about it, is that like basically because of how loaded up the banks are and how affected, correlated, and they are by the bonds, by the large hoarding of bonds that's going on in the banks, they're effectively a leverage play, or at least a proxy play on bonds. So depends on what philosophy is. Some people think that it's best to not do proxy stuff and just go get as pure of a trade as you can. So they would just trade the TLT or something, or trade bonds directly. Some people like proxy trades because perhaps they can exploit some kind of arbitrage there. So it's up to you how you want to play it. If you want to play it, I'm just telling you that that's kind of my little revelation here on this whole banking situation that I've been thinking about over the last few days, trying to figure out if I can actually do something smart about it. So far, I have not. I bought the KRE fund, 50 shares or so, just a small position, and it's returned about -7% thus far. We'll see what happens on Monday. I may double down, or I may buy US Bank. I'm still looking at US Bank. Still not sure. You might have further down to go if it's going to really be a proxy trade to the bonds, at which point maybe in 10-15% I buy, or I can just sell a put and pick the price that I want to buy it at and let it drop to that level. So I most likely will do that. I'm not sure yet. Let me know how you're playing this bank situation, if you're playing this bank situation, and why. What instruments are you using? What duration? What size? I want to know. All right. That's it for now. Peace.